Most retirees budget for standard Medicare premium and move on, but there's a hidden layer that catches a lot of people off guard: IRMAA, or the income-related monthly adjustment amount. If your income crosses certain thresholds, Medicare adds a surcharge which you pay for Part B and Part D, and because of how the rules work, a single tax move from 2 years ago can suddenly raise your premiums. Today I'll explain how IRMAA is calculated, how the 2-year lookback works, and how to plan Roth conversions and smart income timing so you keep more of what you've earned. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NAB Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. What is IRMAA and why does it matter? IRMAA is an extra charge added on top of your regular Medicare premium if your income exceeds certain thresholds. For 2025, the standard Part B premium is $185 per month, but cross an IRMAA threshold and your monthly Part B premium costs will jump by $259 all the way to almost $629 depending on your income and filing status. Your Part D or your prescription drug coverage also adds an extra monthly amount that can be as little as $14 as high as almost $86 on top of your plan's premium. Those add-ons are per person per month and they stack quickly for couples. You also want to be aware of the 2-year lookback rule. And here's the part that most people miss. Medicare uses modified adjusted gross income, or MAGI, from your IRS tax return 2 years ago to set your IRMAA. Your 2025 Medicare premiums are generally based on your 2023 tax return, whatever the IRS shows as your latest available year. If 2023 was a high income year because of Roth conversions, or maybe you were still working, there was a business sale or big capital gains, you will face higher IRMAA charges in 2025, even if you have lower income now. What counts as modified adjusted gross income for IRMAA? For Medicare purposes, modified adjusted gross income is simple. It's simply your adjusted gross income plus tax-exempt interest, and that would be interest you earn from things like municipal bonds. That means that wages, interest, dividends, capital gains, IRA withdrawals, and Roth conversions, as well as rental income, all flow into that number. Roth withdrawals themselves don't show up as taxable income, but Roth conversions do, and they push you into a higher IRMAA tier if not timed carefully. We also want to know where the thresholds are for 2025. The first IRMAA threshold is $106,000 for single filers and $212,000 for married couples filing jointly. And remember, that's that modified adjusted gross income number. Above those levels, you enter the first surcharge tier and the add-ons increase as your income climbs through the brackets. If you're married filing separately, IRMAA is far less forgiving. There are only 2 tiers if the surcharges kick in much lower levels than they do for joint filers. So what can IRMAA cost you in real dollars? And let's make this concrete. Suppose you're a married couple filing jointly with 2023 modified adjusted gross income of $230,000. In 2025, each spouse's Part B premium would be $259 monthly, the standard $185 plus a $74 IRMAA surcharge, and each spouse's Part B would add an additional $13.70 per month on top of your drug plan premium. That's an extra $1,054 a year for the household, before any higher tiers. Push MAGI high enough in Part B alone can run as high as almost $629 per person per month. But don't worry, you can also appeal IRMAA if you think you have a qualifying event. If your income dropped due to a life-changing event, you can also ask Social Security to use a more recent year. Qualifying events includes things like marriage, divorce, death of a spouse, work stoppage or reduction, loss of pension income, loss of income-producing property from events outside of your control, or certain employer settlement payments. You request a reconsideration form utilizing Form SSA-44 and provide proof of the event and your new income. Note, a voluntary Roth conversion or selling appreciated stock is not a qualifying event by itself. So what are some planning moves that help us to keep IRMAA in check? First is to mind your timeline, especially the ages of 63 to 65. Because of that 2-year lookback, the income you report at age 63 will ultimately set what you pay for Medicare at age 65. If you're planning large Roth conversions, business sales, severance payouts, or stock option exercising, consider doing them before 63 or after you're comfortable with the IRMAA impact. Spreading a conversion plan over several lower income years often beats one big hit. The second thing you want to do is use Roth conversions strategically and not let them use you. Now, Roth conversions are a very powerful long-term tool that help lower your future required distributions and give you more flexibility, but they also increase modified adjusted gross income in the year you convert. The sweet spot for many retirees is the early retirement window after paychecks stop and before Social Security and RMDs begin. Fill your target bracket with conversions, but track how close you are to IRMAA thresholds for that year. But sometimes it may make sense to face higher IRMAA surcharges for a year or two. If you're staring down the barrel at RMDs down the line of a few $100,000 or more, it likely makes sense to incur a couple extra $100 of IRMAA surcharges now, but still go through that math just to make sure that checks out. Next, you want to sequence your withdrawals to help with your modified adjusted gross income. If you have taxable pre-tax and Roth accounts, you can choose where cash flow comes from, meaning on taxable principal, which isn't taxed, or Roth dollars in a given year helps keep your modified adjusted gross income lower and may preserve a lower IRMAA tier. Conversely, large IRA withdrawals will lift your MAGI and can push you into a higher bracket 2 years later. You also want to utilize qualified charitable distributions if you're over 70 and a half. If you're charitably inclined, giving directly from your IRA to a qualified charity up to $108,000 per year in 2025 can satisfy part or all of your required distribution, and it won't hit your adjusted gross income, which in turn can help with IRMAA. This is often superior to taking an IRA distribution and then donating the cash. You also want to make sure you're watching your tax-exempt interest and capital gains. Municipal bond interest is great for federal income tax, but it's added back for Medicare for modified adjusted gross income purposes. And capital gains realized in a strong market can bump you a tier, even if you're just rebalancing. Build a habit of checking your protected MAGI before year-end sales. Finally, you want to coordinate with Social Security and claiming your required minimum distributions. Starting Social Security, up to 85% of your benefits could be taxable, and required minimum distributions are fully taxable withdrawals from pre-tax accounts. If you can complete most of your planned Roth conversion work before kick in, that helps manage IRMAA, the Social Security tax torpedo, and your overall bracket pressure later. So how does the IRMAA surcharges actually step up? For 2025, joint filers at or below $212,000 of modified adjusted gross income in 2023 pay the standard $185 per month for Part B coverage and no Part D IRMAA charges. From there, surcharges step up at $266,000, $334,000, $400,000, and $750,000 for joint filers, and half of those levels if you're a single filer. Each tier increases Part B by a set monthly amount and adds a separate fixed add-on to Part D. The result is not a gradual slope, it's a cliff at each threshold, so being $1 over can cost you hundreds more per year. Careful income management around these lines is worth the effort. Also, you don't want to forget if you're married filing separately. If you file married filing separately, IRMAA can be brutal. After $106,000 of modified adjusted gross income, you jump near the top of the surcharge schedule. For couples with disparate income or special tax considerations, evaluate whether married filing separately is worth the Medicare cost. The default for most retirees remains married filing jointly because of IRMAA thresholds are roughly double at the single levels. Now we're going to go through a quick case study. Dana retires at 62 with significant pre-tax savings and no earned income. She plans a multi-year Roth conversion strategy, filling the 22% bracket each year at ages 62 and 63. But her 63-year-old conversion pushes 2023 modified adjusted gross income above the $212,000 limit. At 65 in 2025, her Part B jumps from $185 a month to $259, and Part D adds another $14 on top of that, about $1,000 more for the year. So what could she have done differently? Well, she could have converted more at 62 and less at 63. Shift some cash needs to taxable principal or Roth at 63 to keep MAGI below that line. Or if the spike at 63 was due to a qualifying life event, say job loss rather than a voluntary conversion, file that SSA 44 to request reduction based on her now lower income. So how do we put this all together with a nice checklist? First is you want to project your MAGI every fall, include adjusted gross income, tax-exempt interest, capital gains, IRAs, withdrawals, and conversions. Tie the projection to your Medicare year 2 needs ahead. Next, you want to bracket fill with intent. Use targeted Roth conversions in low-income years, but stop short of the next IRMAA tier unless the long-term tax win justifies it. Third, sequence your cash flow. Favor tax principal and Roth when staying under a threshold matters. Use pre-tax when it fits the plan. You also want to make sure you're leveraging your qualified charitable distributions if you're over 70 and a half. Reduce your AGI while meeting charitable goals. Document life-changing events. If you truly qualify, submit Form SSA-44 with proof to ask Social Security to use a more recent lower income tax year. Finally, reevaluate this plan annually. Thresholds and premiums are updated each year. Assumptions from 2 years ago may no longer hold. For 2025, the standard Part B premium is $185, and IRMAA table shown in Medicare's office materials determine your total. So what's the bottom line here? IRMAA isn't a penalty, it's a formula. But like any formula, it can be managed. By understanding which dollars count toward modified adjusted gross income, how the 2-year lookback works, and how your withdrawal and conversion choices cascade into future premiums, you can avoid expensive surprises. The result is higher after tax, after premium over your retirement, and fewer headaches along the way. If you want help threading the needle between Roth conversions, RMDs, Social Security timing, and IRMAA thresholds, that's exactly what we do here at NAV Wealth Partners. We build plans that optimize not just your investment returns, but your lifetime net spendable income. See you in the next video.